about secondary mortgage markets, like the agency loan you're talking about, Fannie Mae and Freddie Mac. Can you explain roles in today's apartment financing? Can you break it down much more on today's when you look at today's financing?
Yeah, I mean, really. So we talked about the general qualifications. If your sponsorship team meets those general qualifications, you know, the advantages of Freddie versus Fannie, it depends. You know, Freddie seems to be a little bit more aggressive at some points, and then also, what is the plan of the property? What's the, you know, Freddie Mac has more of a kind of they call it the Freddie Mac floater program, where you can only get a 1-year prepayment penalty. So you can almost use it like a bridge product. So depending on the scenario, we dive into that. But really, the agency lenders, they typically have regional offices, and there's a certain amount of direct licensed, let's call them banks or let's call them agency lenders. There's a certain amount of licensed agency lenders, which isn't that many. I believe it's, don't hold me to this, it's somewhere around 20, 21. And they're direct agency lenders, right? And so most, if you're like me, what you do is you work with the wholesale division of these different agency lenders. So we know when we get a deal, we're looking, does it make more sense? You know, is the property contiguous? So sometimes we'll get, you know, it might be a couple buildings. It could be a portfolio of 3 or 4 different multifamily properties. So that's all going to play in. And is it affordable housing? Is there any covenants on the property? So those are the things that might make sense to go Fannie or Freddie based on those scenarios. It's really deal specific, which might be a better fit.
Deal specific.
But really, you know, the other thing is the market itself. Is it a larger MSA, or is it more of a tertiary market? And when we say tertiary market, that means it's more of like a bedroom community, right? It's only got a population of 25 or 35,000 people. It's not a very big city. And then also, these lenders all have different tastes in their mouth about different locations, right? Some markets, they might have had a deal that went sideways in the tertiary market. So that lender is not going to be interested in that market. You know, a lot of times in these smaller tertiary markets, it's hard to find comparable sales because there's not too many 50 or 100 unit buildings in this market, right? And so these are all the things that we have to worry about. And that's why sometimes, even though you have the experience, that agency debt might not be the best. And we might take it to a local credit union or bank for the fact that they know the market. And it's, you know, they like the small community because that's where their bank is, their credit union is. And so sometimes that's the difference. Also, sometimes I like to go credit union debt instead because it doesn't have prepayment penalties, right? And so instead of being trapped into a deal for 5 years, and when you're paying yield maintenance and you know, all of a sudden year 3, there's a big uptick in appreciation, you forced a lot of value into the building, and now you want to refinance, but your prepayment penalties, you know, several $100,000. So that's why we look at the full equation. Now, agency debt is non-recourse. So a lot of syndicators who are raising big amounts of money, they don't want to personally guarantee. Now there are what we call bad boy carve-outs, meaning if there's certain frauds committed or whatever, it's going to be recourse debt. But all in all, agency debt is non-recourse. Same thing with HUD debt; it's non-recourse debt. So that's why a lot of the bigger sponsors want to go agency, because it's amortized over 30 years. It's non-recourse.
Yeah,
if that makes sense.
Yeah.